welcome to another video. Hopefully, you are having a wonderful day today. Today, I took a Euro USD long, which landed into a loss at our buy strong, our time frame, which eventually see we got stopped out instantly, which is fantastic. Usually, if you are in the wrong side of the market, you could see you'll always enter in the retracement of the if you're wrong, you enter on a retracement and you will get stopped out by the expansion that will occur right after that. So enter on retracement, stopped out on the expansion. This is a trade recap. Although we were bullish yesterday and the day before that, market did go up to our high terms on liquidity. Probably you're wondering, well, you're supposed to go here, so how come did you have your bias wrong? As you guys know, there's always a short-term drawn liquidity and a long-term drawn liquidity. A short-term drawn liquidity will always lead to a long-term drawn liquidity. Market can't just go up here. It needs to go through phases. It's probably gonna go, go lower here, eventually make its way to the upside. Because a short-term drawn liquidity always leads to the longer-term drawn liquidity. So today we got stopped out just because of that. So we didn't have no psychological problem, no, execution problem. It was primarily because of the higher time frame. I accidentally matched up my short-term drawn liquidity with a long-term drawn liquidity because I had two type of buys here. I had a bearish bias and a bullish bias in a daily time frame. So okay, let me use the weekly time frame. Weekly time, weekly IRL to ERL. Weekly time frame drawn liquidity was bullish, but that's the longer term drawn liquidity. Daily is a short term drawn liquidity. In the daily time frame, it looked way better to be shorts. But I added up the weekly as a bonus to the longs to make it, try to make it make more sense to go to for longs because I'm going with longer term drawn liquidity. But you can't do that. There's gonna be times where there's gonna be times where the longer term drawn liquidity is gonna be bullish, and there's gonna be times where longer term drawn liquidity is bearish. Yeah, and you're gonna be bearish. I mean, the short term drawn liquidity is gonna be bearish, and you're gonna be bearish. Why? Because a short term drawn liquidity always leads to a longer drawn liquidity. If the long term drawn liquidity is bullish and the short term drawn liquidity is bullish, cool, nothing wrong with that. But usually, always want to go with the short term drawn liquidity over the long term drawn liquidity. The short term will lead to the long term. Why do I say that? Because we're day traders. We trade on 15-minute time frames, so the short term drawn liquidity matters more than the long term. They both matter, but we have to prioritize the short term over the long term. As you guys know, I've said this already multiple times in this video already, that the short term drawn liquidity always leads to the longer term drawn liquidity. So the whole reason why we got stopped out was we went against the short term drawn liquidity and we got stopped out. So our high term bias was incorrect. Now, if you go to a higher time frame, as I said, I accidentally, or you could say I wasn't too conscious of my bias. I'm not gonna bullshit you guys here, but on the weekly time frame with a weekly series to the upside, weekly IRL to ARL. On the daily, we had a daily, as in daily time frame, we had a daily ERL to IRL. The IRL got met, and I was like, okay, daily discounted ERL to IRL, but that didn't make sense because the discount already got tapped, right? And discount for value gap right over here already got tapped here. So daily discounted ERL to premium IRL. This where I got inversed. So we go from a daily discounted ERL to premium IRL. Eventually, we go from a premium IRL back to discounted ERL. But what I thought was a discounted ERL to premium IRL, what I was saying is fair value gap. So as I said, I was in that conscious. I don't know how it had that happened. I thought, okay, the hard time is bullish, so we're gonna have the same bias as yesterday. But new day, new things could happen. If we're in a new day, the old day is gone. We have to we have to redo our analysis. We can't just have the yesterday, analysis. Yesterday, let's just say it's still the same bias here, but still gotta do it because something could change. A lot of things could happen in one day. Could change the whole structure in one single day, right? So we had, as in what I saw, discounted ERL, right, to premium IRL without seeing this IRL, and yeah, that's what led me to fucking up. But before we go to our actual buys that we're meant to have, now let me give you guys more context to the upside. We had a daily CRT to the upside. That's all we had. A classic option profile to the upside. Monday low of the week. On the lower time frame, on the 4 hour time frame, we had a 4 hour expansion dealing range. We can only bind premium once the discount area gets tapped. Discount area already got tapped. We as well had a range low got purged. We're gonna range high. The range low got purged. We're gonna range high as well. We had a In this case, that's all we had. We had SMT. SMT got falsely broken. We're looking for a new continuation. We had a 4 CRT in place. We're looking for a 15-minute marble one. We had a 15-minute marble one and instantly got stopped out, which is, a good thing. We get stopped out very quick. Good thing, because I don't want to be in the market and, the trade takes a long time. Eventually we get wrong. It's going to fuck around with our emotion. But usually if you're wrong, you want the market to stop you out very quick. Usually when you enter a trade, when your boss is wrong, you enter on the retracing phase of the leg. So market did a what? Retracement expansion. You enter on the retracement phase without this expansion high, recent retracement high hitting purge. So the next candle is going to be another expansion to the downside right after this bearish candle. As you can see, every other candle is bearish, 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 bullish, bearish, back to the downside. So we entered in retracement phase. Next candle was expansion phase to the downside. So we entered the retracement phase. We thought it was going to go higher, but we thought it was going to be expansion to the upside. So just as retracement, eventually the market did another expansion to the downside, stopping us out, which is fantastic. And there was no psychology problem. There was no technical problem. Nothing like that. No execution problem. We have followed every rule. It's just that our hard different boss was wrong. Which right now, currently, I've added a rule to focus in the short-term drawn liquidity, because short-term drawn liquidity always leads to the longer-term drawn liquidity, and do not match up the short-term drawn liquidity to the higher time drawn liquidity, the longer-term drawn liquidity. So for the bearish bias now, to what we had wrong here, because as I said, the short-term drawn liquidity always leads to the longer-term drawn liquidity. This fair value gap we don't give a shit about. It's not that we give a shit about this fair value gap. We care about this IFG. So we had a daily. At first, to the upside, it made sense until this daily fair value gap. So if you're long, if you were looking for longs in London session, it definitely made sense. But the dynamic changed instantly, because now after the London session closed, market tapped the daily IFG, daily IRL. Now we go from daily IRL to ERL, daily CRT to the downside. So you can see now it's a little different here. If you're longs for London session, made profits, but if you're longs for New York, you were wrong, because the dynamic of the market changed. Now it shouldn't really get met. So now we go to the other drawn liquidity ratios down here. Now if you go, if you guys more concentrated trade, the downside should have been our actual trade, or should have been our actual bias here. To the downside, it was a daily IRL to ERL, daily CRT to the downside. We have a midweek reversal, Wednesday high of the week. We as well have, we tapped that premium, so you want to go do it as low. We as well had a 4-hour time frame bearish auto flow, because the auto flow, in auto flow market to go for a bullish auto flow, it goes up on this high. So the auto flow is relatively bearish. You can see how the market broke below lows. You can see is how currently breaking below this low. For a bearish bias, which should have been our real bias here, we had a Neo grows a profile one, one accumulation, five by manipulation and expansion. If I'm bearish, I want the line section to make the high of the day, not the low of the day. In this case, I make the high of the day, so I'm looking for Neo reversal. And keep in mind the New York session, the uh, the bearish bias never offered a entry. We had the wrong type of entry, yeah, but the wrong time, so we didn't execute that trade. And you can see right over here, CTI got purged. We're down to a CRT low. We're looking for negative reversal. We had a bearish order flow. We're in the premium region of the daily range. We want to sell. We as well tap the premium daily range within low, which is daily CRT low all down here. We as well had so we had that was a lot of context right over there. Now if you go to lower time frame, the bearish bias context, we had a legit high right over here before this candle closed. Market pressed it out, legit high, but we were looking to trade between 6 a.m. and 10:30 a.m. Looking for this high to get repurged, which never got repurged. The wrong time, we had the wrong time to purge. But you can see market never offered the entry. So if you're looking for a short here, your trade would have been realistically market made a big impulse to the downside. So you're just looking to enter this model one itself. Stop loss right over here and target the low, which is right down here. So you had a semi chance of shorting this down, but I would have not taken it because the timing of the purge did not happen at the right time at 6 a.m. This purge happened at 4:45 a.m. at the high, so I'm looking for the 4:45 a.m. high to get repurged, then go lower at 6 a.m. But that never happened. Market just went down lower, and you can see a lot of people said, "Well, now you're counter trending here. You're not counter trending, so you can fully go to the COT low right over here, which you can see market just went down here. Tomorrow, I'm gonna have another bearish bias. Why? Although in a weekly we're bullish, short-term drawn liquidity always leads to the longer-term drawn liquidity. I'm gonna go back lower, goes below this. We could all go all the way down here. But how are we gonna go all the way down here? Potentially because we have a 4 weekly CRT here. Weekly could go from weekly, you know, ERL to the weekly ERL to discounted IRL all down here. This right here is a discounted region, right? But how do we know we're gonna go lower to down here without going up higher? Is by letting this fair value gap. This fair value gap determines if you're gonna go lower or not. I'm gonna go up high from here. Sometimes market will not tap the discount the daily range, will just go up higher or lower. But this is why we have short-term drawn liquidity. Short-term always leads to the long-term. So if you're confused about the weekly and we're letting the weekly candle to close, we could use the short-term drawn liquidity, the weekly, which is the daily time frame, and let the daily time frame determine our drawn liquidity because daily time frame will always lead to the longer term. Every time frame has its own sets of you know rules, meaning the daily is the short-term drawn liquidity, the weekly is the longer-term drawn liquidity for a day trader like me. But the daily will always lead to the weekly. Keep that in mind. Always will lead to the weekly time frame. This longer-term drawn liquidity is bullish. Market in a daily time did a retracement and went up higher. It seemed random, right? It must be random, right? It's not random at all. Now, if you go to the 4-hour time frame, right here, we had an obviously bearish order flow. Market never closed above this high. We had a daily range here. But the lesson of this trade is to prioritize short-term drawn liquidity, to always be conscious on what you're looking for, and look around. Do the market analysis right. I will, and I do the market analysis right. I will, and I do prioritize the short-term drawn liquidity over the long-term drawn liquidity because the short-term drawn liquidity will always lead to the longer-term drawn liquidity. I added that as a rule in my textbook as well. And yeah, thanks for watching. Make sure you guys like, comment, subscribe, share, and join our Discord links down below. I'll see you guys later. Peace out.